So one of the things that I've been noticing is that millennials seem to be taking stock market investing a little bit more seriously as time goes on. And one of the things I want to cover in today's video is which stocks millennials have been investing in here in 2020. And probably the easiest way to do that is to just take a look at the most largely held stocks on Robinhood, which is probably the most popular investing platform out there for millennials, just because it's really easy to use. You can just do everything on your phone, which we know millennials are definitely addicted to their phones. And it's very streamlined and an easy to use application. And so it's just become very popular among millennials. So what we're going to do is we're going to take a look at the 10 most largely held stocks on Robinhood. And of course, I'm going to share my opinion on each one of them as we go through the list. I'll let you know if I'm planning to invest in any of them myself. And I will also be ranking them from best to worst, just kind of for fun, just so we can just do like a comparison of all the different stocks. So it should be a fun video. I hope you guys enjoy it. But let's go ahead and start with a countdown from number 10 down to number 1. Okay, and kicking things off here with stock number 10, that's going to be the almighty Apple, ticker symbol AAPL, which sells for over $300 a share, is owned by almost 400,000 people on the platform, and carries a 66% buy rating from analysts. And I think I mostly agree with that assessment. It's obviously a great company, but the share price is not cheap, so a 66% buy rating does make sense to me. See, the stock is currently trading about as close as you can get to a record high, and the same can be said about its trailing PE ratio that sits at close to 25, easily making it the highest it's been over the past decade. Of course, many would argue that the price is justified, especially during these difficult economic times, given the strong balance sheet that they have with close to $150 billion in current assets, meaning they have gigantic liquidity, and even if they decide to use much of it for reinvestments or acquisitions, they still generate plenty of cash flow every single year that can quickly replenish those cash reserves, doing over $75 billion of free cash flow over the past 12 months alone, which is pretty insane. Now, this year should be a lot rougher though, given the state of the economy, resulting in less people having cash to buy expensive iPhones, in turn resulting in almost zero revenue growth for Apple expected this year. But over the long term, there should be plenty of future growth catalysts, including 5G, other parts of their business growing like services, which by the way broke a new record last quarter, and of course the gigantic cash pile that will allow them to not only invest in growth, but also pay a growing dividend that currently has a low payout ratio and also allows them to buy back stock, making investors' holdings even more valuable. Add it all up, and I think it's a reliable long-term stock, even though it's currently too expensive for myself, but I'll put them up near the top for now at number 3, and then just kind of readjust as we go through the list of the different stocks. Okay, so moving on to stock number 9. Ooh, that's going to be Microsoft, which is currently my number 1 largest stock in my entire portfolio. And this one is owned by over 450,000 people and carries a very high 88% buy rating from analysts. Not sure if I feel that bullish on the stock myself at these higher price levels, but as a long-term investor, I do actually feel confident in my position, so I'm mostly okay with that rating. But like I said, the stock currently trades at very high levels. In fact, it's only a few percentage points away from a record high, and just like Apple, that's left them with one of the highest valuations that they've seen over the years. But also like Apple, in fact even more so in my opinion, it can definitely be argued that Microsoft deserves to trade for a premium. In fact, in many ways, Microsoft is actually benefiting from the global health issue that we're currently going through, as all the lockdowns and stay-at-home orders have caused a surge in demand for their various services, including Windows operating system, Office work and collaboration software, and of course Azure cloud computing, just to name a few. Meanwhile, they're still expected to grow sales by a double-digit rate both this year and the next, and that's after having already done a gigantic $125 billion in sales last year alone, with about $40 billion of that going straight to the bottom line. Microsoft remains, in my opinion, an absolute beast and one of the best foundational stocks out there, and it's also a pretty good dividend growth stock as well. And given that it's currently my largest stock, I'd have to put them in the number one spot, even if that's a little biased. Okay, moving on to stock number 8, we've got a very hotly debated one here in Aurora Can, ticker symbol ACB, with close to 470,000 people owning it and less than a 25% buy rating, indicating some strong bearishness from analysts. And that's because Aurora is, of course, an MJ stock, which have been getting absolutely destroyed over the past year or so, and Aurora is no exception. In fact, they even had to do a 1-for-12 reverse stock split just because the stock price was trading so low at less than $1 and were subsequently going to be removed from the New York Stock Exchange. But after adjusting for that split, they had theoretically soared to well over $100 per share at one point before crashing all the way down to just $5 a share and then bouncing off of that to now trading closer to 15. Obviously, if the stock was to return to those previous highs, then this would be one heck of a spec stock to own, but it's definitely not one without enormous risk. What I like about Aurora is that they have large capacity and tremendous international exposure with operations in over 20 different countries, but unfortunately that hasn't yet led to profitability, and much of that expansion has resulted in large losses and tremendous share dilution on top of climbing debt. In just the past 12 months alone, they've lost close to 800 million Canadian dollars of free cash flow. Now there is, however, some newfound optimism in the company though, notably with their most recent acquisition of Reliva. I'm not sure if I'm pronouncing that right, but this is one of the best-selling CBD brands in the United States. Apparently, I'm not really familiarized with them myself, but that gives Aurora some much-needed exposure to the largest legal can market in the world. But it's still not enough to get me really excited enough to gamble on the stock, so I think I'll be staying on the sidelines for now. We'll put them somewhere around, let's put them in the number 7 spot for now, since I do think that they are at least an interesting spec play. And if ACB was not controversial enough for you, perhaps Carnival will tickle your fancy. Coming up next, ticker symbol CCL, and this is a stock that I do actually own myself, in addition to the other 474,000 people that own it on Robinhood, even though it carries an extremely bearish rating of just 20% from analysts. And you know what, I actually kind of agree with them, not because I don't think that they can recover, but because it's a stock trading pretty high right now despite having taken significant damage to their business. And that's because the world's largest cruise line is still sitting idle without a clear date on when voyages will return. I've seen some reports indicating some progress happening in August, but according to Travel Weekly, the CEO recently said that it is not currently up to them when sailings will begin, but rather it's up to society when they will feel comfortable with it. And in my opinion, I just don't see businesses like this returning to 100% normal operations and capacity until at least a V-shot is released, which may not happen until the end of the year. And even then, I think it could take some time until people really feel comfortable. Now, don't get me wrong, the stock is still down huge at over 60% this year alone, but my cost basis is currently less than $10, so I'm just not very excited enough at these higher levels. The risk-reward ratio was definitely worth it at those lower prices, but now trading at almost 20, you really have to start thinking about whether this is a good long-term investment for you or not. And hey, might very well be. I don't think cruises are going away, and this is a company that typically performs pretty well during normal economic conditions, but given all the uncertainty and the huge amounts of debt that they have to take on just to help them survive the rest of the year, which of course will deteriorate their balance sheet even further, this feels more like a spec play rather than an actual solid investment. And for those reasons, I'm going to keep them somewhat low on the list, but just barely in front of Aurora at number 6. Okay, moving on to the 6th largest stock on Robinhood, that's going to be GoPro, which is a very surprising stock to me. I'm not sure why so many people are holding it at over 476,000, but this is currently less than a $5 stock and carries the lowest rating we've seen so far on the list at just a 17% buy rating from analysts. Over the past 5 years, the stock has just been an absolute disaster, dropping from over $60 a share and losing over 90% of its value, although it has at least doubled up from the $2 bottom that it hit earlier this year, but that means very little to all the people that have likely been holding the bag much longer than that. Now, GoPro is of course famous for their action cameras that were all the rage back in the day, but have since remained a relatively niche product that is fantastic at what it does and is loved by its hardcore fan base, but it's just never been able to get to the next level in terms of reaching a wider audience, possibly due to the rise of smartphones with amazing cameras, nor has GoPro been able to successfully diversify their business, as is evident with the disastrous attempt to enter the drone market with the GoPro Karma that was a major flop. As a result, the company has lost millions of dollars every year, and although that negative net income has at least been improving, sales have still been stagnant over the years, and they're even expected to crash this year by almost 40%. So it's just not a very enticing gamble to me, and I'm not exactly sure what people are seeing in the stock, especially as a longer term investment. So I'll keep them fairly low for now on the list and put them down at number 9, since I doubt I'll find too many other companies that have less potential in my opinion. Okay, moving on to stock number 5, we've got yet another risky and highly controversial stock in Delta Airlines, although I wouldn't necessarily classify them as speculative because they used to be one of the best run airline companies in the world, at least in my opinion, and that's likely why it carries a more favorable buy rating of over 60% and is held by over 550,000 people. That isn't to say though that Delta is a safe stock to invest in given the recent travel bans and low demand stemming from the global health issue that have destroyed the businesses of many airlines and forced them to take on enormous amounts of debt as they try to survive the current crisis. As a result, Delta's stock crashed this year and is still down by over 40% year to date, but lately it's been on a tear, climbing by over 15% on the day of this recording alone. And while I do own the stock myself, my cost basis is actually in the low 20s, whereas right now the stock is trading considerably higher in the low 30s. Now, during normal times, Delta usually performs very well financially, and over the years they even experienced solid growth at a time when many competitors were actually struggling. I don't have enough time to get into the comparisons in this video, but in my airline stocks video, which I'll try to link down in the description, I covered why I chose to own Delta over the competitors, and given that I like them the most, I'll put them just slightly ahead of Carnival at number 5, as I feel that they're just a little less speculative, but I'll keep them behind the others as the road to recovery will be a very long and difficult one, and the stock is trading too high right now for me to be wanting to buy any more shares at this time. Alright, moving on to stock number 4, we've got yet another troubled company right now that usually performs well during normal times, and that is Disney, ticker symbol DIS, which if you guys have been watching my channel, you know that it's always been one of my larger positions. I do have to admit though that my faith has been shaken a little recently, although I'm still trying to remain optimistic about their future over the long term. But they are currently owned by over 575,000 people and carry over a 50% buy rating, which I'm mostly okay with. 50% sounds reasonable to me given all the madness going on. It does feel like a bit of a 50-50 toss-up right now at these prices if you're kind of looking out to the sort of medium term. Now, currently the stock is only down less than 15% year to date, which would normally be a great dip in a stock like this, but given how horrendous this year is for them with their theme parks in America still not opened, forcing them to furlough over 100,000 employees as profits plummeted by 90% last quarter, and also forcing them to temporarily cut the dividend, you would think that the stock would actually be down a lot more. On the bright side, Disney Shanghai has already reopened, and Disney World in Florida should be opening back up in July as well, but there's still no word on the California park yet, and all of them will be at limited capacity for quite some time anyway, which will adversely hurt their sales. Much of that should be offset though by the huge growth in their streaming platforms, which have all really benefited from the lockdowns, reaching almost 100 million subscribers last quarter and more than half the amount of Netflix, which is kind of impressive. As a result, analysts only expect a 3% drop in sales this year, but in my opinion, they're probably being overly optimistic about those numbers, and either way, profits will still be heavily strained until things get back to normal, so this won't be an easy turnaround by any means, but as a long-term stock, I still think it's more reliable than most of the other options on the list, so I'll put them just barely ahead of Apple for now at number 2, even though it's really kind of a toss-up there with Apple. Okay, now moving on to stock number 3 on the list. If you thought Delta had a big day in the market, American Airlines, ticker symbol AAL, absolutely skyrocketed by over 40% today, and they're currently held by over 585,000 people, despite having one of the lowest buy ratings on the list at just 21%. Now, the stock is still down by over 40% year to date and over 70% from their highs in 2018, but like I said, they just popped by over 40% today, and that was because investors are starting to think that the worst for airlines might be over, as Americans stated that they plan to fly about 55% of their 2019 domestic capacity by July, which is up from the just 20% that they saw in May. Still, I generally prefer Delta, as American has seen smaller profits and much lower revenue growth over the years, while Delta also has more current assets and less total debt. And because I already own Delta, I have almost no reason to want to own American, so I'll have to put them pretty low on the ranking, just barely behind Carnival at number 7, which forces me to slide Aurora down to number 8 to make room for it, even though, I don't know, I don't feel that great about moving Aurora that far down, but it is what it is. Okay, moving down to the last 2 stocks on the list, coming in at number 2, that's going to be General Electric, ticker symbol GE, at close to 800,000 people owning it, which is a bit surprising, as that's a gigantic amount of people that seem to really like this stock, and it also carries a fairly bullish rating of 62% buy. I personally think around 50% is more reasonable, but I admit that this is a pretty hard stock to value at this time. Back around 2017, it used to trade for over $30 a share, but nowadays it usually hovers around $7. So if it were able to make a comeback, that would be one heck of a profit on that stock. But a comeback at this point would be anything but easy. Sales have been falling for years while profits have been non-existent. See, ever since the Great Recession, GE has had to deal with the fallout of their financial division getting involved in risky gambles like mortgages, rather than focusing on solely helping its customers make huge purchases on things that GE built, like jet engines and power turbines and so on. And normally I'd be all for a turnaround story, but General Electric is now having to deal with extraordinary weak demand in travel that is hurting what was once their best performing segment in GE Aviation. Add on the business specific issues of Boeing, which is one of their largest customers, and GE just feels like too much of a risky gamble for me to bet on. Still, if travel demand starts picking back up, the stock might be worth watching, as it's trading at some of the lowest prices that I think I've ever seen, and that makes it a compelling spec stock to keep an eye on. But I think I'll put them just barely behind Carnival for now and slide the rest down another spot. Okay, and that brings us to the final stock of the list, and that's going to be the Ford Motor Company, ticker symbol F, with a whopping over 870,000 people owning it, but a very bearish 21% buy rating. And I think that rating is fair if you're looking short and medium term, but as I've said before, while I'm personally not a fan of Ford myself, I'm probably still one of the least bearish people on it over the long term, just because I do think that they have at least the potential to turn things around, but it's just a question of whether or not they can execute. See, for the longest time, Ford ignored the looming threat of electric vehicles, while something like Tesla went all in on the new technology, and that's why you're seeing explosive growth for Tesla, while Ford has only seen their sales stagnate at best over the years. The thing that Ford does have, though, is a loyal fan base, especially here in America, specifically with their trucks, and in my opinion, they need to leverage that asset before it's too late by selling competitive electric vehicles, which I think we can all agree on is without a doubt the future of the automotive industry. In fact, many analysts are predicting that EVs may overtake ICE sales as early as 2030, with the blue bar there representing ICE vehicles shrinking over time. And while Ford is at least trying to enter the market with the upcoming Mach-E Mustang crossover and eventually an electric F-150 truck as well, the reality of the situation is that Tesla is beating them on nearly all performance metrics thanks to the years of investing in the technology, while Ford is actually at risk of cannibalizing their own ICE vehicle sales that generate all of their profits. I do, however, think that there is plenty of room for multiple competitors, so I don't expect Ford to just completely go out of business, but if they don't take these new threats more seriously, I do think that they run the risk of losing tons of market share. Still, the stock is trading at some of the lowest prices I've ever seen, so I can definitely understand why so many people like it as a spec stock right now, but I'd have to put them in a tie with GE in terms of ranking, and my gut says maybe GE is slightly better, so I'll put Ford at number 7 and move the rest up a spot to fill the gap. Okay, and there you have it, guys. I put Microsoft at number 1, Disney at number 2, Apple at number 3, Delta at number 4, Carnival at number 5, GE at number 6, Ford number 7, American number 8, Aurora number 9, and GoPro number 10. And I think I'm mostly okay with this ranking. Maybe Aurora should be a little bit higher, maybe Carnival a little bit lower, but I think overall these are some pretty hard stocks to rank right now because they have been rallying a lot recently. In my opinion, the market is due for a pullback here, so we'll see if that happens. But a lot of these stocks carry a lot of risk, and the prices just aren't as attractive right now, considering the risk that you're kind of taking on and the issues, the business fundamental issues that you're having to deal with as well. So if you force me to invest in any of these stocks at today's prices, I would probably just go with Microsoft just because that has the best balance of risk and reward in my opinion. And it's also a good stock that I could just kind of hold long term, even if I do think that the market is going to be going lower. And then I could just kind of add to it. So that's kind of the safest choice. I would probably just keep it safe and just go with Microsoft if I was forced to buy at these levels. But like I said, at these levels, I'm just not that interested at this time. But let me know what you guys have to say down below. Let me know your thoughts on these stocks and let me know if you agree with my rankings or if you would adjust it at all. And I guess that does it for the video. But if you enjoyed the video, please consider hitting the like button. It really helps the channel. And I hope you're all staying safe out there. I know there's a lot of chaos in the world right now, but just try to stay strong, and you're all in my thoughts and prayers as always. But thanks again for watching. I'll catch you guys in the next one. Take care. Bye-bye.